What's good, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. Intro, please. So I recently received a new client, and they have allowed me to show you guys one step of their action plan that I tailored for them for Velocity Banking. But before we dive deeper into it, you already know your boy got to do the YouTube thing. So I'm really close to getting monetized. So I'm going to ask you guys, help a brother out. So if you haven't done so yet, take a little bit of time, stop for a second, hit that like button for me. And if you're new to the channel or you've watched a couple videos and just haven't done so yet, please hit that subscribe button for me and leave a comment saying that you're new to the channel. Also, if you enjoy my content, please think about donating to my Patreon. It's only $2 a month and it's greatly appreciated. I'll have my Patreon link in the description down below for those that want to. So I truly appreciate anybody that takes these steps, as it does help me reach a higher audience base. So today we're gonna look at a real life example of how to pay off your loan using a line of credit. Like you already know, we use the term income pays credit, credit pays expenses. This pretty much gets us into the Velocity Banking mindset. Since a loan uses amortized interest and a line of credit uses simple interest, we always want to try to pay off our loan using a debt weapon that's going to charge us simple interest, such as a line of credit. And once we pay off the loan using a line of credit, we're going to use our line of credit as our bank account, meaning we're going to transfer our paychecks right into the line of credit once we get it. And when expenses come up, we're able to transfer that money out of the line of credit and then pay our expenses as they come. So just know, using this technique requires you to have positive cash flow, meaning money that is left over once you pay all your expenses. Your income is higher than your expenses. Now, when we transfer all our money to the line of credit, this reduces our daily interest. As we start to draw money out of our line of credit to pay our expenses, your leftover money at the end of the month will remain into your line of credit, pretty much slowly building that line of credit back up to full. Now, I know this may sound complicated, but you already know I got the whiteboard in the back, so we're gonna break this down. So let's go. All right, so I'm on the whiteboard. Like you already know, we're gonna get down to business. So this is a little part of one of my clients' action plans. I kind of tailored it down, made it real basic for everybody to understand here. So the individual, their income every month is $4,203. Their expenses are $3,651.81, leaving them with a cash flow of $551.19. Basically, the money left over after all the expenses are done. Now, one of my clients' debts is a loan from Lending Club, and the debt on that Lending Club loan is $3,758. Their minimum payment per month is $240, and it's an interest rate of 25%. That is a very high interest rate for amortization there. So this individual, they were able to apply at their local credit union, and they got a line of credit for $20,000, and the interest rate is going to be 8.3%. So let's see how we're going to crunch these numbers down to pay off this debt. All right, so this client, we agreed we're going to start in the month of January. So this is how it's pretty much going to go. In the month of January, let's say January 1st, right? We're going to use some of our line of credit. Remember, he has a line of credit of $20,000. We're going to use $3,758 and pay off the loan in full. Now, in real life, there's probably going to be some interest in there. So it's going to be a little bit higher, but we just want to make it simple, right? You would just call them and say, hey, how much is the whole one-time payment going to be? We're just going to say this much, but know that interest will probably be applied for that payment that you're making to Lending Club. So once you pay off the loan, what this does is it's going to increase your cash flow by $240. Because remember, Lending Club, the minimum payment was $240. We calculated that in our expenses. Now, what that does is it minuses our expenses by $240, right? So the next step of what we're going to do, we see that when we take $3,758, our line of credit, we have $16,242 on our line of credit that's available. And this will be used for emergency uses, right? Let's say you have to get new tires or something. You still have your line of credit to draw from, right? So it's always good to know how much you still have left on your line of credit. Now, the next step is this individual, they're going to use their income, however they get it, weekly, bi-weekly. Once they get a paycheck, they're going to put that onto the line of credit, right? So they're going to put the paycheck on the line of credit, however they get paid. What that's going to do is it's going to pay the line of credit back up to full, back up to that $20,000. And then you're still going to have extra, a surplus of $445 of cash. So the next step that you're going to do, you're going to first use your cash to pay some of your expenses. You're going to put $445 on some of your expenses. And then you're going to use the leftover money on the line of credit to pay the difference. Now remember, our expenses once were $3,651.81. Now, since the expenses went down by $240 because we paid the loan off, our expenses are only $3,411.81. When we use our cash and then the remainder line of credit, we're going to get left with $17,033.19 that we have available on our line of credit. So if we look at the month of January, the debt that we have on the loan is zero. It's paid out, it's done. And then our line of credit is at $17,033.19, and we need to get that paid back to full. All right, so we're in the month of February. So the first thing that we need to do is see what our amount was on our line of credit at the end of January. So we see that amount at the end of January was $17,033.19. So for step one, since we've already paid off the loan, we don't have to worry about this step anymore. We're going straight to this step right here. So we have identified how much we have on our line of credit. Now, what we're going to do is we're going to put our income onto the line of credit. And that's going to fill the line of credit all the way back up to full. And we're going to have some extra cash left. We're going to have $1,236.19 left in cash. So what we're going to do is we're going to use our cash first to pay some of our expenses. And then we're going to use our line of credit to pay the rest of our expenses. If we do the math, we're going to be left with $17,824.38 left on our line of credit. So if we take a look here, the new expenses are $3,411.81, meaning that our new cash flow, $791.19. We are directly seeing this cash flow, right? So $17,033.19. And then we're going to add our cash flow, and this is how we're getting that end amount. So we're pretty much paying off the line of credit by $700 some odd because our cash flow increased by paying off the loan. So we take a look at February here. The debt obviously is zero since we paid the loan off in full, and this is how much we have left on our line of credit. All right, so we're in the month of March. So we already know the first thing we have to do is see what was the amount that we had left on our line of credit at the end of February. So if we're looking at February, we had $17,824.38 on our line of credit. So right here, we had that amount. So the first step that we already know we're going to do once we get our income pays credit. So our income, we're going to put that onto the line of credit. When we put that onto the line of credit, it's going to pay that line of credit back up to that $20,000 mark, right? And then we're going to have cash left over, $2,027.38. So what do we do first? We're going to take our cash reserves. We're going to put that onto the expenses, paying majority of the expenses. And then what's left over, we are going to use our line of credit to pay the rest of that expense, right? So when we end our line of credit here, we see that we have $18,615.57 at the end of March. So let's look here. We have our debt is zero because we paid off our loan already January 1st, right? And then our line of credit, we got $18,615.57. Again, since our new cash flow, $791.19, we're just seeing it added every single time, every month. Our cash flow is pretty much getting put or left onto that line of credit, slowly paying this off. All right, so we're in the month of April. I'm pretty sure we got it down, but we're going to drill it into your head. So we know what we have to do first. We need to see what the amount was on our line of credit the month before, March. So if we're looking at March, we had $18,615.57 on our line of credit. So we're going to plug that right there. And the first step that we're going to do, we're going to put our income onto the line of credit. So our $4,203, however you get it, again, bi-weekly, weekly, monthly, whatever, you're going to put that onto your line of credit. Once you do that, you're going to have some cash left over. It's going to put the line of credit up to full, and then we're going to have $2,818.57 left in cash. We're going to first use our cash that we have, and we're going to put that onto the expenses, paying majority of the expenses, right? And then we're going to use our line of credit, pull the money out of our line of credit. Whatever we need, we're going to pull it out, and we're going to pay the remainder of our expenses. Now, this will leave the line of credit balance at $19,406.19. So we almost have this thing paid off. Again, our cash flow, $791.19. All we doing is plugging that into the line of credit from the previous one, putting it on the new one. So it increased by that amount again. So if we're looking at April, our debt, our loan, it's been paid off since January 1st, increased our cash flow. Now we just working on building that line of credit up, right? So we're at $19,406.19. We only got a little bit left to go. All right, so we're in the month of May, the best month, my birthday month, so let's get this knocked out. So we already know we got to look at the previous month to see how much was on our line of credit. So we know that we had $19,406.19. So we're going to plug that in right there. First step, we already know we're going to put our income onto that line of credit. It's going to fill that thing all the way back up, right? It's going to be paid in full. And then the cash that we have left, $3,609.76. Now, what we're going to do, we're going to use our cash, or we're just going to pay off all the expense. We're going to pay off all our expenses, and we actually have money left over. So our line of credit is paid in full. And let's look at the month of May here. Debt, that's been paid off. Our loans been paid off from Lending Club. Line of credit back up to $20,000. And we got some cash reserve of $197.95. So this is pretty much how you're going to use your line of credit to pay off the loan in full. And then you're using your line of credit as your bank account. All you're doing is once you get your paycheck or your income, You put it into that line of credit, stuff as much as you can. This reduces the daily interest because it's simple interest instead of amortized interest, right? And then you're just going to draw your money out slowly. Whenever you need to pay a bill or expense, you draw it out. And then whatever's left over, because you got cash flow, that's what is slowly going to be paying off. So I really hope this was informative. If it was, definitely leave a comment down below. Remember to smash that like button for me. Make that thing turn blue. And if you're new to the channel, go ahead, take a little bit of time, hit that subscribe button for me. And if you do like my content, please remember, think about donating. It's only $2 a month. And like always, hopefully you guys have a good weekend. Peace out.